If you've bought NFTs or crypto with an investment mindset, there is a worrisome trend that I see with all that not financial advice floating around there, where there's a lot of regurgitation of the headlines and not a real understanding of the macro environment. Because of that, the incoming issues are not being covered, and I want you to all be prepared, and you will be by the end of this video. I want to first quickly address, hey, it's been a while. It's not that I didn't want to create any content, it's just that I couldn't. It has been on my mind in the background. I bought a new camera, I've been trying out some new LUTs, I did buy some new lenses, I'm not using those right now, and I am trying out this new Sennheiser boom mic to simplify my workflow, while the Shure podcast mic, it's sitting on the bench. What I'm trying to get at is, I'm #here to stay. Meta Mondays are here to stay. I'm not leaving, but at the same time, real life comes first, always. No matter who you are, you need to make time for that. But back to the video, what are these incoming issues? Well, to forecast where we are going, we first need to understand where we came from. Now, this was succinctly summarized in a memo from Howard Marks in his annual message to his clients. A little background, Howard is the co-founder of Oaktree Capital Management with about $160 billion in client assets. His memo was called Sea Change, which is a general term for any radical change in attitude or perspective. He outlines 2 sea changes in the investing mentality. I'd argue there's a third, but let's cover what he says first. His first sea change was the adoption of the risk-reward mentality. Now, that might sound weird to all of us here, but prior to the 1970s, the drive really was just to find quality bonds, the ultimate safety blanket for our capital. The sea change was a shift for people looking for lower quality bonds, but only if there was adequate compensation for taking on that risk. The second sea change was the declining interest rate environment from the mid-1970s to about 2009 or so. This helped grow the stock market by about 10% per year. It was a period of optimism. A significant portion of all the money investors made over this period was from the tailwind generated by the massive drop in interest rates. I'd argue there was a third, which was the period of zero or near zero interest rates from about 2009 up till the pandemic. This was an experiment from the Fed, never done in history, and this created a real big asset owner's market. While Howard Marks' second sea change, which was a period of growth to about 2009, after 2009 with what I'm calling the third sea change. Now this was a period of extreme and aggressive growth, a growth at all costs type of approach from business owners thanks to the very easy financing, which was from the very stimulative Fed policy. Now this resulted with a consumer mentality with zero risk aversion and plenty of FOMO. So again, we need to understand where we came from to know where we can go. The unfortunate part is that highly stimulative environment, which is just a tiny blip in the history of investing, but to many, that's their norm. That's the only reality they know, so all projections are based on that type of environment. So that's where we were, and that leads to the present day issues. Make no mistake, most people in crypto today joined during the 2021 bull run, so only again at the end, the tail end of that blip in history. Imagine teaching someone about hockey, but their TV only shows the center ice face-off circle. Or them trying to teach you about baseball, but they only look at the pitcher's feet. That's the same as hearing not financial advice type of advice from those who only know a small portion of financial literacy. Now, am I an expert? I'll be the first to tell you I am not. I also hold that word expert to a very high standard, and I think it's often stretched and overused. I am an accountant, and I do have an accounting and finance education, and I have been in the field for about 18 years or so. There have been 3 market crashes that I have been paying attention to. The key word is paying attention, because if you were born in 1998, you were not paying attention to the dot-com crash as a 2-year-old. I did not live in the 1970s during the financial sea changes, but I was raised by 2 accountants. My parents, they were also in accounting and finance, and they taught me a lot. So again, I'm no expert, but there's enough in my background that makes me cringe when there is very poor, not financial advice type of advice flowing around out there. And that's what I want to do here today on this video and generally in my channel. Give you that full picture, give you the details that are being completely missed. So where do we go from here? Now, I'm going to outline factors that could impact us in general, and then specifically, I'll outline how they can impact our crypto and NFTs. We first need to talk about the Fed and interest rates. People have been celebrating lower headline inflation, and that's good, but the devil's in the details. You see, the Fed has been pretty open in that they prefer to look at core CPI and PCE when making their interest rate decisions. Headline inflation has gone down. Again, that's good, but core is very sticky, as you can see by the red line. Headline is in blue, core is in red. Year to date, core inflation basically has not moved. What about PCE then? Well, the latest report just came in and it came in hot, which is bad. PCE went up to 4.4% versus an expected 3.9%, while core PCE was up 0.1% versus expectations. Now, this will result in a Fed that's more inclined to raise rates even higher than expected and keep them there for longer. I've spoken out many times. There is a discrepancy between what the Fed wants to do versus what the public expects. And I do believe the outcome will be closer to what the Fed's plan is, higher for longer, rather than the straight downward reduction in rates that the public expects. One thing in my book that supports this is looking at the historical timelines. These things almost always take longer to resolve than people expect. Exhibit A, let's look at this bubble chart of the bank failures from the 2009 crisis versus the current one. We already have more combined versus the 2009 Washington Mutual catalyst. But more to my point, bank failures continued all the way through to 2015. In other words, there were 6 years of repercussions. Exhibit B, it took 7 years for the S&P 500 to recover from the losses of the dot-com crash. 7 years. Exhibit C, how long do interest rate hikes last? The minimum the peak rate was held during the last 4 rate hike cycles was 6 months. The public expects an immediate reversal, but we haven't even paused yet, let alone held it there. If you want more info on my thoughts on the Fed pivot and pause, have a look at this video I did a few months ago. All the facts are still very relevant, and it'll give you a better understanding of this topic. I'll link it down below. Kind of related to this is the fact that the Volcker era did a ton of rate hikes, and then reversals, and then hikes again, and then reversals, and that led to a ton of volatility. Rumor has it that Jerome Powell has Volcker's book on his desk. They are front-loading rates and plan to hold it there because of the lessons learned from the Volcker era. Finally, the Fed has to maintain credibility after the whole transitory debacle. They can't be inconsistent by becoming too stimulative way too soon. So again, for novices, the past events that I just mentioned are just footnotes in history, events in a textbook or webpage. The reality is, and you might not like to hear this, but history shows these take longer to resolve. Almost always take longer to resolve. We're talking years, not months. However long that takes, when everything recovers, even if it's longer than expected, where can we go from then? Could we go back to the 0% interest rate, hyper-stimulative economy? Maybe. But again, that was just a blip in the history of investing, and there is another side to that coin that you need to consider. And it's actually a bigger side to that coin. Many say the Fed funds rate should always be positive or neutral. That means it should always be at or higher than whatever the rate of inflation is. So if the inflation target is 2 to 3%, then the interest rates should be at a minimum 2 to 3%. So again, that's less stimulative than the 0% that we've had. For sure better than today, but it shouldn't yield that same YOLO all-in mentality of the last 13 years. Listen, nobody has a crystal ball, but there are a few fairly accurate models that paint us an interesting picture, and it does support this stance. Let's look at one, and let's look at the CAPE ratio, or the cyclically adjusted price to earnings ratio. Now, it evaluates if the market is overvalued, undervalued, or fairly valued. If the CAPE is high, then it is overvalued and likely chance for lower growth in the long term. Vice versa if it's low. Now, this model has been accurate in predicting 10-year returns, even when backtesting using the past 130 years of data. So the CAPE ratio today for the S&P 500 sits at around 29, while the NASDAQ sits at 35. 10 to 15 is the ideal, and anything over 20 is considered overvalued, hence predicting lower returns in the next decade. In fact, with this CAPE ratio, some say we should get around 6% returns per year versus the historical average of 10%. That's a big deal. If inflation remains high as well, then we also risk stagflation, and that's a whole nother issue. So we've been very technical with the background economics so far, and trust me, I'll get to how this affects our crypto and NFTs very shortly. It's just important to understand the background first. Does this mean zero growth? No, it just means growth won't be as widespread, so you have to find those gems. There's less of a chance you can just close your eyes and throw a dart, and then that'll go up in value. At a basic level, higher interest rates equals lower valuations. Lower valuations leads to less funding. Higher rates also means if you do get funding through debt, it costs more to finance that debt. So that's less money and more expensive money for growth. When it comes to Veve and Ecomi, we do know they're backed by Blackbird Venture Capital. And that's all we know. We don't know if it's funded by debt obligations or by equity, but what I can infer is that Ecomi has developed their forecasts, their pro forma income statements or financial statements, and then secured funding to fulfill the needs according to that plan. The critical question is what happens when or if things don't go according to plan. You see, we've already seen some of the economic stresses taking their toll on our industry. Maybe it's a combination of the economic stresses plus bad deals, but we do have two recent examples. Number one, NFL All Day reportedly hasn't generated enough revenue to cover the minimum it agreed to pay the NFLPA, and the NFLPA is threatening to sue. Also, Recur just retired the NCAA platform. We don't know why at this point. It could be maybe Recur had no cash, or maybe it was just a bad deal to start with. Regardless, there are stresses in our industry, and I hope Ecomi baked in those stresses in their pro forma financials. Otherwise, the current funding won't be enough. The somewhat good news on top of all that is, as I've pointed out in past Meta Monday episodes, they are making a good amount of revenue, top-line revenue, relative to the rest of the global NFT marketplace. Now, we don't know what their other financials look like, and that is very important in making any definitive conclusions, but strictly as a comparative statistic, I'll take that as a good sign. All right, let's summarize this video and point out the things you need to be wary of. Now, number one, when I do these economic and financial videos, my goal is to give you a step ahead before it's in the headlines, before it's trendy to talk about. Just like last year when I was the first of the Veve fam to cover the macro side and how it affects our space. It was trending months later and everyone became, surprisingly, everyone became a financial advisor somehow. That will happen again, and you need to be wary of the regurgitation of the headlines after they're trending to talk about, because once they are trending, you no longer have the edge in the markets. Remember, regurgitation of the headlines doesn't mean people understand the information. I find these usually come from the people who tout meme coins after they're trending on Twitter. Regardless if you've made money or not, it doesn't matter. A first-year finance student will tell you, look up the efficient market hypothesis. Listen, don't get me wrong, there are a ton of knowledgeable people in the Veve fam. When it comes to finding crypto gems, off the top of my head, check out Chris Coffey, Kyle Wilson, and Doc of Stuff. I see these guys on social media and they are in the trenches, actually researching these things before they are trending. That I respect, but that is also few and far between. So original content like that gets lost in the noise of the Moonboy hype. The second thing I want you to be wary of is be prepared for the paradigm shift. Now, I'm not saying this is 100% guaranteed, although I have presented here in this video some very compelling evidence supporting it. My biggest issue as I scroll through crypto and the NFT space, simply going back to all-time highs next year, it's a foregone conclusion. In this new paradigm, it's not that easy and definitely not as quick as most think. Number three, on that same note, we need to be wary of misleading statements. Things like, this crypto or NFT is an easy 10x the next bull run. Or statements like, hey, these will easily surpass all-time highs next year. Listen, all-time highs are a funny thing to forecast. Just look at where some of these collectibles were. You can get access to all past financial data on cherrycharts.com. You can track your buys and sells, use their MCP maximizer tools, which are just a few of the many features. You can sign up using my affiliate link, HODL Fandom, and get 50% off your first 3 months. I'll put all that information in the description below. Back to those misleading statements. On one hand, they are using the old paradigm that may never show up again. Those all-time highs were also massively inflated by the insane amount of money printing on the macro side. Within Veve, within the micro, let's not forget the effect of cheap gems, the whole gem scandal, and the peak of bot activity which artificially increases demand. That peak also coincided with the peak in prices. Will all those happen again at the same time? I personally don't think so. On the other hand, I believe there are still a ton of positive catalysts to come, especially with Veve and Ecomi. But if you combine this with what I've said in this video, be prepared for these catalysts to also have a much slower development timeline. Plus, the positive reaction to those catalysts should be slower as well, as support for risk-on assets like crypto and NFTs in the new paradigm won't be as prevalent and widespread. So what's my strategy going forward? Well, I've said this many times. I'm just collecting what I like. The characters I like or the collectibles I've always wanted, as long as the price makes sense to me. We might be on this ride a lot longer than initially anticipated, but with that strategy, I feel like you can't lose. And with that strategy, it'll make sure that in the long run, we're all #here to stay. Thanks for watching.